All right, everyone, welcome back to another episode of On the Margin. Today, I'm joined by Mr. Jurrien Timmer of Fidelity and Plan B. Gentlemen, welcome to the show.
Nice to see you, Mike, and Plan B.
Thanks for having me. It's a great. I'm looking forward to it.
We've got a lot of really interesting stuff to get into today, so I just want to dive into it. Jurrien, I'm going to share my screen here. You literally put together the best charts, certainly on Twitter, that I see. And I'm going to be kind of referring to them here as we go through this episode. But I want to kind of start off with what your thoughts are on financial conditions, the Fed's tightening cycle, and just what global central banks are doing in general. So, Jurrien, you kind of kicked off this last newsletter that you sent to me before this, with just your own thoughts about where we are in terms of the tightening cycle and kind of the narrative that is forming around interest rates. So you just walk us through kind of what's on this chart and what your view is on the Fed and central banks globally.
Sure, and it's all very nice to see you both and to have this conversation with you. I'm very excited to be here. But so this is an interesting Fed cycle, or it's turning into one, because I think a year ago we all knew that the pandemic would run its course and the economy would kind of return to normal, and that the 0% Fed policy, not only for the Fed but around the world, would no longer be justified, and certainly the 120 billion in asset purchases per month would no longer be justified. But at that point, the expected curve for the Fed to normalize policy was very gradual, very smooth. And basically, if you looked at the Eurodollar curve or the Fed funds curve, or even in this chart here where you see the number of expected rate hikes by various points in time for this year, the curve was very smooth back then, a very gradual return to normal, which would be around 2.5%, which is where the median dot is for the long-term view of the Fed. Or if you take R-star, the natural rate, which I think is around 0.5% or so, you add 2% inflation, you get to 2.5%. So a year ago, that was the curve. Obviously, a lot has changed. Inflation has proven to be a lot more stubborn and hot than I think a lot of people expected, certainly at the Fed, but I think generally in the marketplace as well. And of course, we got last week's number coming in hot again at 7.5%. And so since the December period, when we got the minutes from the previous FOMC meeting, and then the December meeting, and then various further speeches by the Fed, the path has been accelerated quite aggressively, and now actually the expectation is that there'll be 6.5 rate hikes this year. Obviously, it'll be 6 or 7, but that's what the market is pricing in, and so that kind of takes us out of the kind of the 2015 to 18 analog, which is what I had been looking at in terms of a gradual, smooth return to normal without any real urgency. And now there clearly is more urgency to that. But what's interesting to me is that, and you can see that in this chart, that as successful as the Fed has been at moving expectations in the market and giving that sense of urgency that, we need to do this sooner, faster, the market is still pricing the end point of this cycle at around 2.25%, 2% in a couple of years. So even as the curve of expected rate hikes has moved forward, the endpoint has not. And I think that's kind of a riddle in the markets at this point, because when we take, for instance, the 1994 cycle, which I think is becoming more and more relevant, and that was a long time ago, but back in the 90s, it was the Greenspan Fed, and Alan Greenspan, the maestro, as he was called, would love to kind of troll the markets in a way by raising rates when it wasn't expected, or raising them by more than 25 basis points. And so in this chart here, you can see the red and blue line in the upper left. Those were the Eurodollar curves back in December of 93, before the surprise rate hike started. And at the end of the rate hiking cycle, which was in February 95, and you can see that those curves were upwardly sloping in both cases. And even at the end of a 300 basis point cycle, which of course the market didn't know it was the end until until that became clear later. But even when the Fed was done, the market was still pricing in another 130 basis points or so of tightening. Contrast that to now. Again, like I said earlier, a year ago or even 9 months ago, the expectations were for a very gradual return to normal. So that's the blue line on the right-hand side of the chart. And now we have the red line, which is a very rapid return to not even quite neutral, but close to neutral, and then basically nothing or even a Fed easing. And I think the way to look at how the market, could thread this needle is that I think the benign interpretation is that the market concludes that the Fed is making the markets do all the hard work for it by setting expectations and jawboning the markets, and that the hard part will be done by the markets. Financial conditions are already tightening. The 2-year notes as we speak is 157. The 5-year notes almost 2%. The 10 years at 204. So the market is doing a lot of the heavy lifting for the Fed, and I think the glass half full interpretation, therefore, would be that the Fed really just has to do a lot of talking, but if the markets are doing the work for it, when in a year or two from now, the Fed won't really have to go much above 2. The alternative interpretation, of course, is more of a glass, half empty view, which is that the market thinks the Fed is going to have to chase inflation until it breaks something, and then we get a 2018 scenario during which the market, of course, fell 20% fairly quickly, and that forced the Fed to pivot to a more dovish outlook. My guess is that it's going to be the former and not the latter, but it certainly is a conundrum that even with all the hot inflation numbers and all the talk from the Fed about more, faster, sooner, that the market still expects this hiking cycle to end below neutral. Even if inflation comes back down to 3 or 4%, which I think is likely over the next couple of years, the Fed would not even end this cycle at a neutral point. And that seems inconsistent with the kind of inflation numbers that we're seeing.
And I really love this chart because it sort of as the time period of my entire career on it. It's 1992 is about the period that I started college, and 1998, the first crisis there, was the time I started working. So I vividly remember all these periods in time, and especially the rate movement. So what I like about this chart is that you see the 3 crises so very well in the chart. So the 2000 internet bubble, and the Fed had to accommodate that by lowering the interest rates, of course, which and it's much lower than the actual 10 years rate. It's also a short maturity rate, of course, but you can obviously see the difference between the Fed rate and the 10-year rate being very high after that 2000 internet bubble. And the same happened after the global financial crisis in 2008.